Okay, so we can get started. You're welcome to another session of Thriving in Canada webinar series, our monthly webinar series uh, where we try to connect as many people as possible with information that will empower them to thrive in Canada. So, a little bit about me. My name is Dotun Afuda. I am an independent insurance advisor and I live here in Ottawa. And basically, my everyday work is to help my clients build financial security for themselves and their family. But I'm also a very big believer in the power of information to transform people's lives. And that is the driving force behind this webinar series, Thriving in Canada webinar series. Because I absolutely believe that with the right information at the right time, you can thrive in Canada. You can build wealth, you can live above the average, and you can live above the struggle that most people come to experience here in Canada. So this webinar series is all about connecting people with the information they need to do that. And in today's series, I'm happy to share that we have a guest speaker. Today, our topic will be centered around smart credit moves for new immigrants, building wealth the Canadian way. And our guest speaker is Mr. Nelson Wabo, who is a credit and financing expert. He will be guiding us through the presentation. So I just wanted to mention, if you have questions as the presentation is going on, please feel free to leave them in the chat, right? At the end of the presentation, we'll be able to go through the questions in the chat and provide as much answers to those questions as much as possible. And I'm sure at the end of the session, if you have more questions, you'll be able to connect with myself or connect with Mr. Nelson to ask your questions and basically seek more clarification.
Yes, it is. So, welcome everyone. I'm just going to introduce myself very briefly. My name is Nelson Wabo. I have been in the consumer credit space, personally and professionally for over 10 years. And I am really hoping that I know that we're very little participants here right now, but I'm hoping that some of my experiences can be beneficial to you as we go along. I know Dr. say you can leave your questions in the chat, but I'm a very, very conversational person. Like I feel like we can just interact, and if you have any questions, if you don't have to wait to the end, you can really just stop me so that we don't lose our train of thought. From a career perspective, I'm a project manager for a software company, and I also coach people and help them position themselves in order to qualify for credit, loan, etc. Right? One thing that I've realized over time since I've been here is that Canada is a credit society, and a lot of things as we'll see in the slides as I start sharing them are highly dependent on your credit profile, and you know that as the world becomes more digital, we are always trying to integrate data, and this time your credit data becomes even more important. So without really just further to do, let me just go through this slide and just explain what a credit profile is. Now, I don't know how long you've been in the country, but this is just basic understanding of credit. Credit profile is a summary of your financial position in Canada, right? And it gives you the credit score based on that entire credit profile, right? So that's why I said that the credit score are an important part of your financial profile. Now, one of the importance of credit is that it can be used to make really some of the most important financial factors in your life. And over the years, I've started to realize, because it wasn't like this like 7, 8, 9, 10 years ago, right? But now I'm starting to realize that uh different things really now needs you to see your credit, right? Sometimes it's even obviously we know about getting a mortgage or getting a car, but now even going to rent an apartment, the landlord would most likely pull your credit just to find out if you have a good credit. And that goes without saying that he's just trying to figure out if you're disciplined enough to maintain a good financial profile, which would translate, or he assume or she assumes, the landlord, that translationally, it means that you are disciplined enough to pay your rent, right? And increasingly, we're starting to also realize that even when you're trying to apply for some jobs, right, they do all these background checks and things like that, right? But some jobs are starting to pull your credit to see, especially jobs in the finance space, to see that if I'm going to allow you manage funds or manage budget. Well, I want to see how you manage your own personal funds, right? So these things are tying up, these data are starting to tie up, and we're trying to see people even lose important things or milestones in their life, like getting that job that they really want because they have faulty credit or a bad credit profile. Generally, over 70% of Canadians carry debt in some form, right? Like we talked about mortgages, car loans, what kinds of credit cards, those kinds of debt, because Canada is a credit society. There's almost nothing you can do without debt. Now, a lot of us are from Nigeria. So when we come in here, Nigeria is still cash based. And I know that they've started giving mortgages and things like that in Nigeria, but largely Nigeria is still cash based. You build your house with your cash, you buy your car with your cash, right? But Canada is different. And the quicker we kind of tailor our mindset to understand that a lot of things must pass through credit, that's how the economy balances itself. The better it will be for us to position ourselves so that we can access those credit when we need them, right? There's high, low, positive, negative, right? So there's more to your scores than you think. And depending on where your numbers for your lending and the credit options will vary. What that means simply is that when you go to the bank and say you want to get a credit, it depends on how much or how high your credit score is or how much credit you already have. The positive and the negative on your credit bureau, when you pull them, the banks or the credit underwriters makes decisions based on all these factors. And I'll go through it with you and I'll let you see from the position of the applicant, which would be you and I, and from the position of the credit underwriter, which would be what they see in your absence, right, before they make a decision. Am I moving too fast? I can slow down if I'm moving too fast.
For me, it's a good pace. Does anyone think it's too fast?
It's a good pace for me as well.
Okay. All right. Thank you. Now, so let's talk about credit agencies. Agencies literally are the ones that are responsible for attaching or assigning a credit score to you. In North America, there are 3 credit agencies, but in Canada, there are 2, right? Equifax and TransUnion. So they are data aggregation companies, right? So when you open up an account with, say, CIBC, RBC, or even your Rogers bill or your Bell bill, right? These companies send the data of your utilizations of the different products they've given you to Equifax or TransUnion. Now, Equifax and TransUnion or TransUnion aggregate the different data they are getting from the different organizations that you are affiliated with and come up with what they think is a responsible or an appropriate score to say, based on the utilizations and how this person organizes themselves financially, I think this person has XYZ score. Now, credit score ranges from 0 to 900, right? If you don't know that, that's the range, right? And we'll talk about this scores in the next slide or two, I can't remember. But they give you these scores because they want other potential lenders to say, if Equifax has assigned, say, 500 to this person, it means this person does not know how to manage credit. Now, remember, there could be many reasons, and these scores are generated every week, every 2 weeks, every month, right? Depending on times and how you use your credit. So remember, there are instances that can happen in your life that could alter your credit score, right? So you buy a new house, obviously you're getting a loan from the bank for a mortgage. You buy a new car, it's going to report. You buy groceries or you buy something from Amazon, those data keep passing to the agencies and the algorithm keeps refining itself to say, based on your current status, this is the score that I think you are assigned to, right? Or this is the score that I'm assigning to you. Now, so the second slide really just explains what I said, like the agencies collate your data submitted to them by all financial institutions and gives you a score. Now, we all know, and even I don't know when you guys left Nigeria, but everyone talks about it right now, right? Data is the new gold, right? So regardless of what you do, your credit data is tied to many things, what you want and what you need in the credit society. So this is an example of a credit score, right? It depends on where you fall in, but if you look on the right-hand side here, you can see that if the lowest I think anybody has gotten is 300 from what they have here, right? But it starts from 0. But if you fall in between 300 and it's saying 692 here, but I really don't believe that, but it's considered poor. Then as you go up, you say between 693 to 742 is fair. A good credit score really should be between 750, right? That's when you are in control when it comes to you go to the bank or any fintech companies that you want funds. When your credit score is over 750, you can almost say that unless there are other things, which I will discuss in this slide, unless there are other things that would make them say no, chances are you've already lit up the eyes of the underwriter to say this person has the ability to repay because they can manage debt very well. right? So then when you get into the 800s, you start saying that you can be considered an excellent credit user. And so these guys will chase you to give you loan. Doesn't mean loan is a good thing or a bad thing, but they just feel more confident to say this person has an 800 credit score, 820 credit score. They must have been doing something well, especially if they've been in the credit, if they've had a credit profile for like 3, 4, 5, 10 years, right? So, and you still maintain that kind of a high score, then it means that you must be doing something very right? So this really just explains everything I was trying to say about the credit score, understanding it, the different place where you fall in. If you fall in any of these places, you can just read the slides and understand that, okay, you know what, 750, 650, I should aim to get higher, right? That's what you should do. Now, between 650 and 750 is considered good to lending. I'm just going to focus on the third one here because that's where I find most people falling, especially new immigrants, right? Because when you come in, you're either worried or you're ignorant. It has to be one of those two because I've seen a lot of people being ignorant about their credit score and they don't really care about repayment, mostly because of how our brain is wired and the society we're coming from. But if you fall into this range, the lenders consider you good. If you're asking for a mortgage, they consider 680, somewhere around there to be very good, right? Because obviously it's a secured product. So when you fall into this category, your goal would be, I want to move into the next stage. If I'm 700, I want to get to 720 in the next 3 months. Now, what do I have to do? I have to look at my entire credit profile. I have to look at what I currently owe and what I currently have and how I currently use the product that I have. How do I pay on time? Am I paying minimum payments? Am I paying more than minimum payment, right? Do I have to clear the debt once? Which truly the answer is no to me personally, because I'll explain that to you. But most organizations look at it from, if I gave you $50,000, for example, right? And I told you that you have to use it because that's why you asked for it, but you don't use it for like 2 years, then I wouldn't look at it that you're very nice, even if I think you're nice. But the truth is that it's possible that you're also scared of using credit, right? So utilization is also part of the reasons why you can have a better credit score. But overutilization can be a reason why you don't have a good credit score. So there has to be a balance between utilizing it and overutilizing it. Okay. This is why you need credit products. Now, the title of this seminar or this webinar is about building wealth, but this is why you need credit products. One is growth. You know, one of the most important aspects, and we're all immigrants here, right? If you are immigrating into Canada, you want to grow, right? Let's just call it spade a spade. But to grow, you must acquire things, right? And most acquisitions, as we know, are tied to our ability to qualify for them. Because not everyone can really just go and bring out $1 million cash from your pocket when coming to Nigeria to buy a home. Averagely, home prices from a townhome is going around 600 in Ottawa. So not everyone can just bring out that amount of money. So you have to qualify. And a good credit profile enhances your chances of qualifying for different things, like I said, such as mortgage or even a car loan. Now, savings. A better credit score usually translates to a lower interest rate. And most people don't know this, right? So when you go to the bank, you can have a credit card or a line of credit. Let's just focus on easy ones like line of credit, which is a very easy product that people, I think for people who don't have it, should try and have because it's better than the credit card, right? But you go to the bank and you can see that you and I going to the bank, we have different credit scores, but we came to the country at the same time. But they give both of us, say, a credit card or a line of credit, and I have, say, 10% or 8%, but you have 12%, and you wonder why. But the difference is that they trust me better. They don't want to lose my business, and they feel like this person has been a loyal customer to us for a while. This person has managed his credit for a while or her credit for a while. And I feel like giving him an enticing thing like a lower credit would help him stay better and even use that line of credit better. Now, to me, when I get $10,000 line of credit, for example, at 8%, which means that if I utilize the $10,000, 8% is what? $800, right? I have to pay $800 for 1 year as interest. But to someone else, if you go and they give you at 15%, it means you have to pay $1,500 interest over the year, right? If you hold the full balance of the $10,000 line of credit. But that's savings there for me because I saved $700 more than you. And I only did that because they trust me more and they see that my credit score is better. And that's why I tell people that you have to ensure that you are getting the best deals from the bank. And the best deals is based on your relationship with the bank and your level of financial, discipline in terms of what the credit profile says. You have to ensure that all these things are in place before you actually approach the bank. The last option that I have there is flexibility. Now, with a credit, I don't know if you've ever, sometimes you can stay on your own if you have good profile really, and you just say that the bank has approved you for a higher credit on your line of credit or credit card, or you are pre-approved for maybe RSP line of credit or something like that, right? They give you all these things because you have a good credit score. Now, if someone that has a bad credit score walks into the bank, chances are they will give you a credit card for 22%, right? But if you have a good credit score, then you have the flexibility of different credit products. And it's not just the line of credit or the credit card or consumer loans, but it can also be if you go for your student line of credit, right? If you want to go to school and you want the bank to give you a loan, if your credit is very bad, they're going to be very, very watchful. Remember, the eyes or the way we look at students is that they are a little bit indisciplined because of the stage in life that they are, right? They don't have any income coming in. And so why would I want to give you $15,000 if I can already see the trademark that you are very porous in using credit, right? I have to be very careful because you have to look at it from the perspective of the shareholders of the bank as well, how they try their best to mitigate risk, to only give people that they think would repay them. So that's why if you have a good credit score, like I said, you have the flexibility of getting different kinds of credit products because they are at peace with you and they trust your judgment financially. Okay, any questions? Okay, let's move on to the next slide. So these are the pros and cons, and I think I already touched on this before. These are the pros and cons of using credits, right? If you have a good credit profile, you certainly have lower interest rate, which I've explained here a few minutes ago. If you have a good profile, your qualifications for loans and mortgage will be faster and easier. If you have a good credit profile, your employment would be better. Trust me, it will be better because the employment or the employers are starting to look at this, right? Even rental applications, I've explained that before. Landlords now, if you go on Rent Faster or all these rent platform, if you're trying to rent your house or rent a basement or rent something out, if you register for this platform, you see where when somebody reaches out to you to say, I'm interested in viewing your property, these digital rent platforms now say next step is ask for the credit score. And the reason why they do that, like I've explained, is they just want to make sure that you have the best tenant because every landlord's fear is a tenant that doesn't pay, right? Now, if you have a good credit profile and manage your credit well, there's this intrinsic, notion that it translates that this person is disciplined enough to say they pay their bills on time, and rent is a bill, right? One of the pros also is lower insurance rate if you have a good profile, right? I know Dotun is in the field, so I don't know much about insurance, but however, I hear that you get lower insurance rate if you have a good profile, and that's a lovely thing because insurance is a killer when it comes to this Western society. And lastly, it gives you peace of mind because if you have different credit products, you know that we have family obligations, we have friends, we have needs, we have wants, we have people asking us for money, we have projects that we are doing in Canada or maybe even outside Canada. And sometimes where your salary is just not enough, and at a particular time, you really want to just invest in this, in whatever you want to do, and you have your line of credit or your loan debt that you can just call on at that moment just to use, and that's peace of mind because at any time you want it, it is available. But I also found that people fear debt, right? Especially new immigrants, that they fear debt in this country. And the question is that why people really fear debt, right? One is that it can make you feel out of control because of the fear of the unknown. I've met people here that say, oh, I don't want to owe $1,000 or $2,000 or $3,000. I beg because I don't want people to come knock on my door or pay $20 every month. But it's okay, right? Because once again, the society is heavily dependent on the utilization of credit. It's a revolving society, right? So we are in one form or another going to buy things with our credit cards or lines of credit, right? Another reason is that people are impulsive. Some people fear that, I can manage it. However, I could qualify for this credit. However, I'm an impulsive buyer, right? Which means whatever I see on Amazon or eBay, if it just catches my eyes, I'm just going to buy it. And that would lead to overspending, right? And the last item that I have here is the lack of affordability leading to late repayment. So sometimes you can qualify for credit even though your credit score is a little bit shaky. And I always tell people that look at your income, look at what you earn, look at what comes into your wallet, and look at your disposable income, which is after all your expenses, what remains in your wallet. You have to be able to incorporate your repayment plan of any debts, credit card, lines of credit, loans that you owe in your income that comes in your wallet. And so if you can do that, then you know that you can pay. But when you cannot afford it, then that would lead to, slow payment, missed payment, and late repayment, which really, really goes back and affects your credit score. Now, how to use and maximize credit. there are 5 points here, but I just want to focus on three, right? These 3 points here are just the most important one to me, at least as a person. Over time, I've noticed that repayment, when people use credit, so you go, even when you're buying gas, for example, right? Those that are afraid of credit obviously use their debit card, but those that are not afraid of credit just use their credit card. But I tell people that you want to build your credit score, you have to use it, right? And if you use it, then you have to pay back. So even if you have the money in your checking account, use your credit. And there are many pros, excuse me, there are pros of using your credit. Use your credit, buy gas for what, 60, 70 bucks, then go home and pay it off. Now, one, you've shown the lender that I used your credit, I borrowed $70 to buy gas, but I paid it off in 1 or 2 days. There's no interest there, right? Because your credit statement comes, what, every 3 weeks, I believe. So if you can pay it up in 2 days or 1 week, you're not really going to be charged interest there. But you have actually sent that data to Equifax and TransUnion, like I told you, that this person has used this and this person has paid on time, which shows them, the algorithm at least, that you are a good credit user and you pay on time. The second item there is utilization. During my time when I used to approve credit and things like that, I noticed that some people, so most of the banks, I'll tell you, most of the banks would not give you unsecured credit that's over, say, $40,000 or $50,000, right? Depending on the policy of the bank. So you find people coming into the bank saying that they want, let's say you already have $30,000, but you want extra $30,000 because maybe something important came up. But when I look at your credit, I notice that, well, I've given you $30,000 last year, but you haven't used it. If you really want to be fair to the banks and the underwriters, why would I give you an extra $30,000 or an extra $20,000? You haven't shown me that you can actually use the first one that I gave you for the last 1 year, right? Remember, again, we're all immigrants here, right? So a lot of people, you would say, because they are unsecured credit, right? These credit cards and lines of credit are all unsecured credit, which means that there's nothing tying you to the lender apart from your name and your SIN number, right? So you can actually take the line of credit or the credit card and you leave the country if things are hard for you, right? And they will not be able to do anything. So that's why they put that risk threshold to say we would not lend any individual or any consumer more than $50,000. Now, if you have gotten, say, $20,000 in the past and you've used it, repaid, used it, repaid, it's all there in your credit profile, right? We can see that. And we can say this person has been using it. They even have liquidity in their checking account, but they need more because maybe they want to buy furniture, for example, or they want to pay for their tuition fees for their friends, for their kids. So these things are what plays on the credit underwriter's mind, and they say, you know what, this person has used these ones that I've given them, they just want more, and I think they can pay, especially if they have a good credit score, right? So that's why utilization is very good. And how people also maximize credit, believe it or not, is your age on the credit bureau, right? So if you've been there for 10 years or 8 years or 7 years, and you've utilized your credit well, chances are your credit score is going to be higher than someone that's been there for just 1 year, because they've not been enough proof to show that the person has managed debt very well over the last 1 year compared to someone that's been there for 5, 6 years. Okay. These are the things that can affect your credit profile. Now, a lower credit score or a bad credit profile shows the lender that the applicant might not be disciplined enough to use borrowed funds, like I explained severally in this session. Late or missed payments is one of them. Please do not miss your payments and do not be late. Pay off your debt, even if it's minimum payment, on time. But pay off, if you have the ability, pay off more than minimum payments. But if you do not have the ability, at least pay off minimum payments on time, right? I don't advise people to wait for 3 weeks or 1 month and pay the next month. Like, when you use it in the next 5 days, if you have the money, just pay it off so you don't get caught up with late or missed payments, right? Also, if you have too many multiple credit accounts open up, it kind of raises a whole lot of questions, like, is this person a credit seeker? You just want to get credit for the sake of getting credit, right? It can affect you positively or negatively, right? If you also have a high credit card balance, like you have, say, 10,000 credit, your credit card limit is $10,000, for example, and your balance is like $9,500. That's very, very high. Now, we're not even talking about the interest rate here. That's very, very high, right? So you need to be able to pay down and maintain that 50% utilization where, say, you have a 10,000 credit card like the scenario I just painted. If you owe $5,000, that's reasonable enough. Then you can start paying off monthly a little over the minimum payment to make sure that you maintain that very disciplined credit repayment history, right? So also having too many credit applications. So you see people that jump from, because you're trying to get a loan, you go to CIBC, to TD, to RBC, to National Bank, to Scotia, you're just jumping. And when you're jumping from different credit, there's a reason why they're denying you if you want to be fair to yourself, right? There's a reason. Either your credit score is bad or you already have too much credit that is bigger or higher than their risk threshold. But when you have too many credit applications, what happens is that each of these credit companies make an inquiry into Equifax or TransUnion. So whenever they ask Equifax or TransUnion, Equifax mostly really, that I want to give Nelson credit. He's asked me, he's submitted an application for credit. That inquiry itself, that inquiry into Equifax reduces your credit score because it's a hit on your credit score, right? So if you had 800, you probably wake up the next week and see you have 795, right? So imagine if you go to 5, 6, 7, 10 lenders asking for credit and they all hit your credit like that, then your credit goes from 800 to 770, right? And that affects you. So you have to be careful how many times you approach certain lenders for application for credit. That's why it's important for you to package yourself properly, make sure your income is right, your credit is right, your financial profile is nice before you approach this guy, so that you know that there's almost no reason for them to say no, unless you have a bad credit, right? Any questions? Okay. The time is 12:05, so let's just continue. So these are the things that the credit under, and this is very important because I wanted us to look at things from the other side of things. So these are things that happens when you do not know. You're not there when people are approving or making a decision on your credit. So if we're looking through this, like we have to look at it from the perspective of the credit underwriter that sits on his desk and say, I have an application from Nelson saying he wants $10,000. The first thing they look at, or one of the things that they look at is your income. How much do you earn, right? Now, your income is tied to your debt ratio, right? So how much do you earn and how much do you currently owe in the combination of all the debt you have? So all the loans, the mortgages, the credit cards, the lines of credit, how much do you owe? If I see that you're not able to service it based on your current debt, then I will deny you. Of course, like I said, they look at your credit profile too, which is really what tells them how much you owe, because all those debts, the data for the debts that you owe have been sent to the credit profile, which creates a credit score, and it credits a financial profile for them, right? So they look at all these things and say, you know what, I will deny this person because this person owes too much and the person, or I think the person cannot service the debt. One other thing that they look at is the asset and liquidity, right? So if you're coming to ask for, and I'm going to use a random example here, if you're coming to ask for $20,000, and you have $0 in your checking account, how would you pay? That's one thing that they look at. Remember, you may say, oh, I earn $50,000 in my job, or I earn $100,000 in my job. You can say all those things, but you don't save. If you don't save, then it means that because there are some debts that do not report on the credit bureau, right? That they know that. So, but if you don't save, then it means that if I give you this credit, you would use it and still not save, which means that your repayment is going to be a little bit tight or becoming difficult. But if they see savings in your account, then they know that even though your job is there, when those bills come and bills keeps coming, you have that savings that you can just chip in from and just pay out that debt, right? At least every month. They also look at your employment, right? And I'm going to act like a credit underwriter now. If I have someone that has been in a job for 3 months and I have someone that's been in a job for 3 years, who do you think I would give credit to? Assuming everything is perfect, right? Of course, it's going to be the guy that has been there for 3 years because I know that there's some sort of stability there. The person is not hopping jobs. And that also means that the person has that stability in terms of income for me to say the loan I'm about to give this person is to an extent safe, right? And finally, what they also look at is the purpose of application. This is very, very important. This is extremely important. Maybe even sometimes, if everything goes well, more important than every other item I've listed here. When you're coming to ask for credit, you have to say what you need a credit for, right? Do you need to go to school? Do you need to get furniture in your home? Do you need to go for vacations? Those things are very important. And even though they are soft reasons, they are the intangible reasons that makes an underwriter look at your credit and make exceptions if they have to make exceptions or not. Right? So please do not just, because I've seen applications, trust me, I've seen people come in for absurd reasons why they need credit. I don't even want to talk about it here, but I've seen people come in for those kinds of reasons that you have to ask yourself that why would I want to give you so much money to buy something so absurd? Excuse me.
Mr. Nelson, I have a question.
Sure.
So if I go to a bank and I apply for a credit to buy a business, for example, will the income, the current income, if I'm buying an existing business, will the current income of that business factor into whether that credit will be approved or not?
Yes, it is. So that's small business, and that's a nice question. But small business is different from consumer, right? I know I've been talking a lot about personal side of things because you are so the business. If it's a corporation, then it's incorporated. But if it's a sole proprietorship, then it's your income, your NOAs, your individual income that will be factored in. But if it's an incorporation, then that incorporated revenue over the last 3 years, they use your financial statement over the last 3 years to say, has this company been making business? And if we lend to them, can they incorporate our monthly potential repayment into their financial statement and still retain that profit that they claim that they've been making? That's how they look at it. Yeah.
Oh, okay, that leads me to another question.
Yeah.
If, for example, I see a business, I want to buy that business, right? Let's say, for example, the owner is willing to sell the business for $100,000, and I would like to come up with $80,000 because I already have $20,000. When I approach the bank and say I need credit to buy that business, are they going to be looking at my own personal credit worthiness, or are they going to be factoring in the worthiness of the business?
Both of them. That's why I said if it's an incorporation, then they have to look at the business side and the financial statement of the business side. But if it's a small business, a sole proprietorship business, then it's you, right? Because you're responsible for everything. It's not protected by any corporation legalities there. It's just you. So that's how they look at it. But then again, either way, you still have to play a role because remember, you're the one applying. That's why most people, when they come for incorporated loans, sometimes it's the business that is borrowing the loan, not you. It's the business, right? There's a different way to look at it. Now, if you say that, you know what, use my personal profile because I want to be a guarantor on this business, of course, they will use your personal profile, right? And $80,000 is not even that much, to be fair. I know it's an example you're giving. It's not that much. If you already have $20,000 and your profile is nice, then chances are you will get that loan easy because remember, is asset and liabilities here, right? So remember that the business in itself generates profit already. So they have to write out all the expense of the business, just like if you even have so let's use an example. If you're going to buy an investment property, right? The property pays for itself, right? Through the rental income and things like that. However, but it's a business, but however, you are the owner of the investment property. So they have to use your credit profile to look at it and say, this guy has enough good debt and good profile. The business rental income should offset the mortgage and the rest will become profit. So they'll give you $80,000 to buy it, right? So that's just how it works. They look at both the individual side and the corporation side of things.
Okay.
Okay. So if there's nothing else, let's continue. See, building wealth is not rocket science. Like we're all adults here. Traditionally, there are just two ways of building wealth. You either increase your revenue or you cut back on your expenses, right? So how to increase your revenue? You get a new job, you get a new contract, you create passive income for yourself, you invest in real estate or the stock market. There are different ways of increasing your revenue, as long as you know that you use the right risk appetite and get, if you have $5,000 today, by this time next year, you should have $10,000. You've increased your revenue, right? You've increased your income. The other way would be cutting back on your expenses, right? So as Nigerians, mostly when we come here, sometimes I feel like we're not very cooperative in how we do things. I don't know if everyone is just trying to show off to the next person, which, in my opinion, at this age and time that we all are, it really doesn't make sense to me personally. We should be able to help ourselves, collaborate, cooperate, and grow together, right? So when you have someone, if you're going to Montreal or you're going to Toronto, for example, why do you have to drive all the way when you have a friend that is going? You share rides, right? Save that expense. You pay for gas, but you share the rides. You share accommodations, like I know some people do here. You don't have to rent the entire house yourself. If you know you do not have the money, if it's going to be tight on you, save those extra $500, $700 every month. It comes up when you add them together, it comes up to something at the end of the year, right? Some people have Crave, have HBO, have subscriptions. You have Netflix, Amazon. You have so many subscriptions. Like you're watching one for music. I don't know, but I just feel like when you add all those $20, sometimes you're paying like $150 for different subscriptions a month. That's like $1,800, right, every year. So you have to sometimes understand the phase in life that you are in, create a financial plan of where you want to be in the next 5 years, and whatever it takes for you to cut down on those expenses that would stop you or hinder you from getting there, you do that, even if it means reducing your subscription. I didn't even know this, but I would buy gas at night. That's just very funny for me because I didn't even know that until maybe 3 months ago that gas is cheap at night, right? But then it's cheaper at night. And so why, even though it's just 10 cents cheaper, why don't you just buy gas at night? That kind of fills your tank faster, right? And saves you. It adds up. Like at the end of 1 year, you might decide that you might find that you 10 cent, 10 cent, 10 cent, you might save like $200, right? Which is something. Okay, someone just asked a question, you answered. Okay, which is something there. So let's move on to the next slide. Now, how to cut back on your expense. And this is a very important slide. You have to, first of all, differentiate between bad debt and good debt. Very, very important, right? An example of good debt is your mortgage. Your mortgage is a good debt. I know it's a lot of expense, it's a lot of debt, like you can be owing 500,000 or 800,000, but it's a good debt because one, it's secured. You can't even run away, right? You cannot pick up the house and run away. So the bank gives you that and they give you the mortgage at the lower interest rate because it's a secured debt, right? And also, it's also a good debt because equity grows on your house if you have a home, right? Equity grows. So every other year you can expect, depending on the house, most house averagely grows by 10% every year, right? So you're building equity there. You're paying that at a lower interest rate. And you are paying your principal, also reducing your debt. So it's a very, very good debt to have, even though people get scared of it because of the amount you have to pay. Sometimes you have to sit down and mathematically compare how much you pay for your mortgage versus how much you pay for rent. And I've seen people that pay $3,000 a month for rent. And I've seen people that pay $3,000 every month for mortgage. And I say to them that, well, in hindsight, if you pay $3,000 for mortgage, given the current interest rate, then it means that you're really paying $2,000 interest and $1,000 principal, somewhere around there, right? And that would mean that you own a home that grows by extra $40,000 every year. You pay $2,000 per month compared to someone that pays $3,000 for rent and gives it to the landlord because you're helping your landlord, that landlord pay his own mortgage or her own mortgage. Now, I know everyone is not in the same phase in life in terms of some people cannot afford it right now, but when you have the ability, do a financial plan and try and see if you can get into the market and start building wealth, because that's one of the ways, whether we want to accept it or not. Sometimes it's too crazy, but that's one of the ways of building wealth in Canada. Now, another good debt would be student loan. And I call it a good debt for two things. One, the interest rate on the student loan is very low. And two, because it's called a student loan, chances are you're using the loan to go to school, to improve yourself, improve your knowledge. That's a good debt, right? But the bad debt would be consumer loan, car loan, credit card debt. And it's not that hard to know. Consumer loan, the interest rate is high. Credit card, the interest rate is extremely high. I don't think we can avoid credit cards because we need to buy things with our card sometimes. But if you have other credit products, like I've mentioned in this presentation earlier, when you buy things, so if you don't even have the money, but you have your credit card and your line of credit, buy with your credit card. And when you go home, use your line of credit to pay off the credit card, because it's better to owe on your line of credit because of the lower interest rate than to owe on a credit card for 22%, right? That's just simple maths, right? I wrote car loan as a bad debt because I know that, once again, everyone wants to drive the best car, and that's good. Have fun if you can afford it. But a car is a depreciating asset, and we all know that. And so once an asset depreciates in value, then it's not necessarily a good debt for you to owe. So unless you absolutely need it or want or need it, sometimes you have to find a way to plan yourself in a way that no one is going to applaud you because you have a Tesla Cybertruck, right? We're going to say, oh, nice, good, but that's about it, right? You're the one that's going to hold the debt for however long that you signed up. So I'm not discouraging anyone to do that. I'm just saying that you have to make sure that you have your proper financial plan of how you want to owe and the things you want to owe on while you maintain a very, very subtle lifestyle. Right? So you can do this by ranking your debt by interest rate, which really is what you lose by holding that debt, like I've explained, and start paying them off. How to build wealth, borrow for income producing assets. Like I said, yes, borrow for your mortgage versus rental. Use cash back on your credit cards for loyalty bonus. And I find that people it's weird, but I find that some people do not really use this. Now, if you have your credit cards and you don't have those loyalty things or those promotions like cashbacks, please go back to the lender and just try and get something like that, because it's very, very important, especially if you use credit. Because for every time you buy your gas or you buy groceries or you buy something from Amazon, those things can add up, and you buy furniture, you buy appliances, they give you cashbacks, they give you all these things because you've used their system, you've used their product, you've used their credit cards. And sometimes you find at the end of the year, you have cashback worth $200 or $300. That can go a long way into buying gifts for your parents, for your siblings, for your kids, Christmas trees and all those things. So that's positive, right? Whether you want to accept it or not, but that's $300 that you would not have gotten by leaving your money in your checking account, for example, right? That's $300 you wouldn't have gotten. So that's a little bit of wealth there. Take advantage of balance transfer. Now, these are for people that already owe, like you already owe $15,000 in your credit card, right? I don't know if anyone, but I do get them, right? So I want to believe if I get them, a lot of people get them as well. You get notification from your bank that says, we are doing a promotion, transfer balances from your let's say you use Scotia, they'll say transfer balance from a non-Scotia account to Scotia for 2%. And no credit or no interest rate for 6 to 12 months. That's very beautiful, right? Because if you owe $10,000, 2% is what? $200, right? So you pay $200 to transfer the credit over to the next bank, or Scotia is asking, for example, and you keep $10,000 without interest rate. That's free money, right? It just costs you $200. Now, knowing very well that if you credit card is what, 20%, like average, like we said, right? So if you hold $10,000 at 20%, that's $2,000, right? You have to pay as an interest cost, compared to $200 that they're asking to bring those debt from different financial institutions to their own site for just $200, and you won't pay anything for 12 months. So you see, technically, you've saved like what, $8,000, $1,800 there, right? So that's the way I like to look at things, right? Every savings counts. Do not discard it. Do not think it's just $1. No, if it adds up, it adds up to $100. Then you can use that to do something tangible for yourself or for your family. Now, there's something called FRAL. It's called fix your line of credit, right? So if your line of credit, say, have $10,000, there are times when the promotion comes up, they can say, you want to, especially now that interest has been very wobbly, right? I know it's been stable for like 2 months, but over the last time, variable interest rate was going up, I think in 2022, 2023, and 2024, then it started coming down again, right? If your credit card or your line of credit, for example, is at $10,000, some banks can say, fix it. You can fix it at 4% for the next 1 year. Now, you know that there's almost no line of credit that is at 4%. There's almost, because it's an unsecured product, right? It's only your mortgages and all those secured products they can give you at 5%, 4%, and like that. But lines of credit cards, they're unsecured product, and line of credit is much better than credit card. But you can still find line of credit at 10%, 9.5%. So when a bank tells you fix it at 4% for 1 year, you should grab that offer, because that's almost like lending or using funds. Do whatever you want to do, whatever property, whatever investment, whatever project you have, at a very nominal rate of 4%, compared to some lenders, especially those that have bad credit, where they can even give you loan at, I've seen 35%, I've seen for 45%, because these guys have no choice. They need money to survive. They need money to live daily livings. And these loan sharks are giving you at 40%, at 45%. Even in Nigeria, I believe that a lot of people are getting at 20-something% loans, right? So imagine getting someone giving you $10,000 at 4%. That's gold to me personally, because I'm in the credit space, right? So take advantage of things like that. And like I said, cut down on your subscriptions like Netflix, or maybe even discontinue them. One of the last slides that I have is consumer loan. And this is really for people that have, when your credit is really very bad. Now you owe all this, you owe like 50 grand, you owe like $70,000, you owe like $30,000, you cannot pay. And the banks are starting to call you. They're starting to call you. They're trying to say that, you know what, you have to pay. You've missed so much payment. Your credit score is really, really trash at the moment, because it's going to be like 500 or 600. So you're feeling very, very bad, but there are other options like debt collection. They've called you. Sometimes the bank have actually written your debt up that this guy or this lady is not going to give me back these funds. The collection agency can say, you know what, instead of $4,000 you're owing, pay $2,000. Those things are some of the strategies people use to pay off debt before they start rebuilding their credit. But one thing that I'm going to try to encourage people not to do is consumer proposal versus bankruptcy. Do not fight for bankruptcy. Do not accept consumer proposal, because it stays on your credit profile for 7 years. And if you're going to be in this country for 7 years, 7 years is a very long time not to use credit, because once a credit analyst or an underwriter sees Nelson has consumer proposal 3 years ago, they're not going to give you credit for the next 4 years, which is 7 years, right? So imagine if at that time your kid is graduating from school and you want to fly, you want to whatever you want to do, but you just need that loan to fly or swipe your credit card and all those things. You cannot do it for 7 years. You have to live from cash, and it's very difficult in this country, like I've explained before, to live just using cash unless you brought so much liquidity from your home country. And I think this is the last slide, which is really the misconception that I think most people have. Some people believe that if I'm debt-free, it means you are wealthy. No, that's not what it means. No, debt-free really means that you have sound financial health, but it doesn't necessarily mean that you're wealthy. And these are for people that are really scared of using credit, right? The rich people have no debt. People think that, but no, we all know that even Dangote and all those rich guys, I know how much Dangote comes to my colleagues' banks to borrow, right? They borrow because they really believe that I have to use somebody else's money to create wealth for myself and to increase my wealth. Because what that simply means for the rich guys and those guys that really use debt is that they've transferred the risk to the bank, right? I get $1 million from you. I've transferred the risk to you. If anything happens, especially for corporations, you can go and hold the corporation, but you cannot hold me, Nelson, right? Because I didn't borrow the money, my corporation borrowed the money. So that's why the rich guys always use debt to invest in different investment tools, stock market, whatever you want to call it, right? And that is a good way for people to understand that debt can be a good source for you to grow, because we all have to grow here. We all have to collaborate and we have to do things properly. Okay, all right. So that's it. That's all I have on LinkedIn. My name is Nelson Wabo. This is my telephone number. This is my email. If you have any questions, you can always reach out to me. If you want to qualify, if you want to package your whatever you want to do when it comes to the credit lending space, I can always guide you and show you how things are done if you choose to use my service. But really, the most important thing for me is that we all have to stop being scared of using credit. We all have to start understanding that we want to, and I'm not saying be rich, stinkingly rich or wealthy, but be comfortable. And sometimes that comfort comes by understanding your financial profile, managing it very, very well, and using it to the best of your knowledge to grow wealth in Canada. Okay, thank you. I'm going to stop sharing my screen now, if that's okay.
Thank you very much, Mr. Nelson. Thank you. I personally learned a lot from the presentation. I'm sure everybody also learned a lot. Like your final comments, very important. We get to understand debt and credit and how to use it to our advantage instead of just being scared of it, right? Which is the mindset we tend to come with from Nigeria and other developing countries. So there is a question in the chat box. It says, do you have any practical tips on best loyalty cards / cashbacks?
So tips for me, like the banks give it to you already, right? If you go to the bank right now, the one time I went to the bank and they say, "Oh, you're still using this old card? Oh, we've not discontinued, but we have a loyalty card now. We have a cashback that gives you like 1%," because they can tell you if you're buying gas, it's 1%. If you're buying groceries, it's 2%. It depends, right? Every bank is different, right? So you should go to the bank if they haven't reached out to you. You should go to the bank and say, "I want a credit card." But remember, or I want to switch your credit card if you have one already. But remember, if you're applying newly, then your credit has to come correct. You have to have a good credit profile to show that you have the ability to pay that debt if they approve you.
Yes, and on practical, I can give examples. A Wealth Simple Mastercard, although it's not exactly a credit card, right? It gives 1% cash back on all purchases. And if you use Scotiabank offers, I think, 2% cash back on groceries and 1% cash back on other things. But also another valuable, it's not just cashbacks, right? There are points you can exchange to buy things like travel, holiday. I'll give an example. Recently, I had booked the ticket to Washington for $780. And then that night, I was just scrolling through, and this is the power of information. I was scrolling through TikTok, and I saw a video about a girl talking about how to transfer credit card points into airline miles so that you can buy first class tickets for cheap. So then I remember that, oh, I actually have a CIBC credit card. Let me see how much points I have there and what I can get the flights for, right? So I went, checked, and you wouldn't believe I booked that flight with my points and ended up paying $150 for the exact same flight on a higher level, right? So I wasn't on the base level, I was on the higher level. So I booked it with points and ended up paying just $150. And I've paid over $900 for with points for my flight to Nigeria also. So these are also ways that all these credit card help you. And you get those points by using your credit card to make your regular everyday purchases. Nobody is asking you to chase points and be spending on your credit card. The regular purchases you make every day, groceries, electricity bill, that bill. In fact, there are things that let you pay your rent with credit card. There are services that let you pay your rent with credit card, right? So you can use this to gather points. It's from your everyday transactions, and then use those points as savings either on your travel or holiday or to get cash back or whatever it is. There's another question here. It says, can someone use a credit card to pay off huge hospital
So,
bill and
so
other
the person says,
statutory bills?
can I take a line of credit to pay off a huge hospital bill? The answer is yes. But the question I'll ask you is that can you repay it? It's not just to use credit and just say, I just want to pay it off. Obviously, it's yes, because the line of credit interest rate is way cheaper than the
He
credit
actually
card.
said credit card. Can I use a credit card?
Oh, the one I'm reading from Solomon that says, can I take a line of credit to pay off a huge hospital bill? Hospital bill.
Okay, okay.
Like so, but the answer is yes. I'm just saying that if you had the option of using your credit card or your line of credit, but please use your line of credit. It's just very simple, right? So 10% versus 20%, that's half of the interest there already, right? So use your line of credit, but do not use your line of credit and do not pay your line of credit. You have to use it and make your payment every month. And for those who say, sometimes I can forget. No, you should not forget. If you're paying your Rogers bill on the 15th of every month, then just pay your line of credit, even if it's your monthly payment or minimum payment on that same day. You have to be disciplined enough to say on the 15th of every month, I would pay all the debt that I owe, whether it's there or not, whether it's the due date or not. And you shouldn't even wait for the due date, right? Pay it like 1 week after utilizing it. Just pay something and move on to the next stage so that it kind of reads when your credit score is being, analyzed by the credit bureaus.
And I will say this, talking about hospital bill, right? So this is where also having, not being penny wise and pound foolish, as they say. If you are in Canada as a resident, a permanent resident or work permit, you are on OHIP, right? So you get a lot of coverage from hospital. But if someone is visiting you in Canada, make sure that person has a travel insurance because too many people have gone into financial problems for something they could have covered for $200 or $300 or $400. If a visitor goes to the hospital, a visitor to Canada, whether they are on a visitor's visa, student visa, or what is it called now, super visa, if they go to the hospital, they are not covered by any provincial health plan and they will pay the full hospital bill. People go to the hospital, do routine procedures like appendicitis, stay 3 days in the hospital and come home with $40,000 bill, right? This is something they could have covered with a $300 travel insurance that will cover them for 60 days or 90 days or whatever for their trip. So please, protect your finances by looking at where can insurance coverage protect me and my family if the worst should happen. We don't pray for the worst to happen, but we should be ready for it because nobody can pick and choose when these things happen. So that is also something to pay attention to. Do we have any other question? Okay, so as a round off, right? I'll quickly share my screen for those of you that are on here. Mr. Nelson mentioned that there are two ways to grow your to build wealth. Either you increase your income or you reduce your expenses. Now, for many of us, reducing the expenses might be the most difficult route to take, right? As Elon Musk said, it is easier to make an extra $10,000 than to try to cut down $10,000 in expenses, right? So that is why I will share to you. You can also increase your income. So first, I will just put it out there. Life insurance can be an excellent tool for building tax-sheltered wealth. You can get to provide adequate protection for your family today and also grow tax-sheltered wealth for yourself for tomorrow. That is about that. But you can also build your income by you work 9 to 5. What do you do between the hours of 6 and 9? Let's say you take 1 hour to rest between 5 and 6, right? That is the time you can use to start building wealth for yourself. Either you learn a skill, take a course that will improve you, or start a business that will start allowing you to earn something extra on the side, right? So if this sounds like you are just looking to make extra 2,000 a month to kind of make sure you can save 2,000 a month. Let's assume all your income right now is paying the bills, right? You have no savings, but this extra 2,000 a month will make sure you can save more during the month. Or you want to start building your own business, or you hate the fact that there is a limit to how much you can earn from your job, regardless of the effort you put in, or you just love providing solutions for people. If any of these statements relate to you, then I encourage you to reach out to me, right? Because we can talk about how you can get licensed to start offering financial services and also build your business there. You can earn, you can help those around you, and you can also build a wealth of knowledge you can apply to your own finances to really make you thrive in Canada. So if any of those things I've mentioned describe you, please don't hesitate to reach out. These are my contact information. You can connect with me anywhere, and then I will be happy to walk you through what this is all about. So we are right at the end of our presentation. So once again, thank you very much, Mr. Nelson, for taking the time to share your wealth of knowledge on credit and structuring our credit properly in order to build wealth here in Canada. And everyone, thank you for joining us this Saturday morning. If you have any questions, please feel free to reach out to me. If you want Mr. Nelson's contact, if you didn't get it from the screen he shared, you can also reach out to me. I will send you Mr. Nelson's contact. And the recording of this video will be available on YouTube during the week. So please, you can subscribe to my YouTube channel. You will also have access to the past editions of Thriving in Canada webinar series there on my YouTube channel. So thank you everyone for your time and have a lovely weekend.